August has been soporific. Stock markets have ebbed and flowed in a gentle susurration, a collective holiday from excitement after the mania of Brexit. The contrast with August last year is also stark, a month when a surprise Chinese currency devaluation was followed by a generalised, if temporary, mayhem the world over. Yet the question which might be asked an eventful year later is, what has really changed? Consider the apparently divergent paths of the UK and Europe. As you can see from the chart, British stocks were the smart choice as September began last year. Including dividends, an investor in the FTSE All-Share is 12% richer. MSCI's broad index of European shares, excluding the UK, has lost our imaginary shareholder 1% of their capital. The markets took their own route to different destinations. Note, however, that we have compared the two markets in local currency terms. Approach it from the perspective of a US dollar investor, and suddenly the difference is hard to spot. Before UK voters decided to leave the EU, the two markets marched in lockstep. Since then, they have diverged only slightly. In dollar terms and with dividends, the UK is down 4%, while the rest of Europe has dropped by 2%. The conclusion might be that for all the political and economic developments of the past year, a form of stasis has set in. Estimates for corporate profits have been declining, largely offset by central bank measures which help to support asset prices. Or, to cut it another way, the rising value of UK companies has been a form of money illusion. They are broadly worth the same, but the pound is not. What it suggests is an evolution of the common complaint of recent years, that central banks are cause of all market movement. Now, all that matters is the value of currencies and where they go from here.